After reviewing hundreds of retirement income plans, we've noticed something consistent. Even well-prepared retirees fall into the same 5 tax traps, and they don't even realize it until the money's already gone. Let's make sure that's not you. In this video, I'll explain the 5 biggest mistakes we see, how they happen, and how they can impact your retirement income plan over time. And most importantly, how we help our clients minimize or avoid them. Number 1, large retirement accounts can create large RMDs, which can be a burden. One of the things that many people don't realize is that at age 73, government forces you to take out a certain percentage of your retirement accounts per year for the rest of your life. And sometimes people have accumulated large account balances in their retirement accounts. Thus, they're forced to take out large amounts each year and pay the taxes on those, which can be a burden. And the reason this can be a burden is because that income can affect how your Social Security gets taxed. It can also affect the premiums that you pay for Medicare. It can also affect other things that occur on your tax return, like what capital gains tax bracket you fall into. Number 2, pay attention to the OBBBA and beware of rising tax rates in the future. With the new One Big Beautiful Bill Act, or the OBBBA, these new tax laws have a few things that may affect you in your retirement. Number 1, there's been expanded deductions for seniors, which could be beneficial. There are also some new laws regarding charitable contributions if you don't itemize, which could or could not be beneficial given your circumstance. Furthermore, remember that this law, the One Big Beautiful Bill Act, only extends the current tax cuts until 2028, meaning they aren't permanent. And that means that tax rates in the future could rise depending on if this legislation gets extended out or not. Number 3, be aware of the widow's penalty and late stage taxes. What happens for some clients is that they have relatively high income, and when one spouse passes away, they're subject to the widow's penalty for their survivor spouse. So what this means is that before the spouse passed away, they were filing their tax return and they were filing it as married filing joint. But now, since the other spouse has passed away, they're forced to file as single. And what this does is it puts them in a less favorable tax situation because they have the same amount of income, but now they're getting taxed at single brackets instead of married filing joint brackets. Thus, this is why it's called the widow's penalty. There's other late stage taxes that you want to be looking out for, but this is probably the biggest one that we've seen that people just aren't prepared for. But there are things that you can do to help get prepared for that. So for example, one of the things that you could look at doing is, for example, looking at Roth conversions earlier in your retirement so that we're not being subject to high taxable ordinary income. Another thing that we do for our clients is look at, well, maybe when we're looking at to do those Roth conversions and we do those in lower income tax bracket years when they are retired, why don't we also look at investing some of the proceeds in their trust account into a tax-aware hedge fund that produces ordinary income losses and exchanges that for capital gains, which is taxed at a lower tax rate. And this will help them offset some of the taxes due on the Roth conversion. And if they're not able to convert everything to their Roth IRA before their later years, for example, in their 70s or their 80s, having this tax-aware hedge fund helps to consistently deliver those ordinary income losses that can then offset ordinary income from things like required minimum distributions, from their pensions, from interest ordinary income, and other ordinary income sources. Number 4, the Secure Act can make it expensive to leave a large IRA to your children. What does this mean? Well, let's say, for example, you leave your children a $1 million IRA account down the road. Well, if they're going to be able to inherit that, before the Secure Act, they used to spread out distributions from that IRA over their life expectancy. So they only had to take out a small percentage out each year over many years and then spread those taxes out over many years. Now, with the Secure Act, your children will have to pull out that money within 10 years. And what's the problem with that? Well, if you leave them $1 million retirement account, for example, they're going to have to pull out that entire $1 million within 10 years. And most of the time when these kids inherit that money, they're in their 40s or their 50s, they're in their highest income earning years, And it's not uncommon for people in California to be in the 50% tax bracket between federal and state taxes. So if you leave them $1 million IRA account, it can be expensive because they're gonna lose about half of that to taxes. So it's important to realize that with the Secure Act, your children are no longer able to spread out those beneficiary IRA or inherited IRA required minimum distributions over a long period of time. Now it's been shrunk into 10 years. And the reason why that's important to note is that there are things we can do proactively to plan in order to help move some of that money into your Roth IRA, or in an ideal planning scenario, move all of that money into the Roth IRA before your kids inherit it. So clearly there is some planning that can be done. Not everything is gonna work perfectly, but we can see how that looks for each client situation. Number 5, estate planning is getting trickier and trickier. Right now, the estate planning exemptions are relatively high. However, there's always proposals that are looking to shrink these exemptions down or reduce the ability to use charitable giving strategies to help you give more efficiently and reduce the estate cost expenses. And it's important to know that if you fall into a category where your estate is larger than the exemption, your estate gets taxed at 50% pretty quickly. So it's important that you keep up to speed with these estate planning laws, that you understand the ramifications, that if these exemptions do get cut down, what is your next move? And it's also important to look out for new laws that may get passed that limit your ability to use trusts or other charitable remainder trusts or charitable giving strategies to help reduce your taxable estate and thus your estate taxes due. If there's one thing we've learned after reviewing hundreds of retirement income plans, it's this: taxes are rarely the loud problem, they're the quiet one. RMDs, widow's penalties, the Secure Act, rising rates. None of these feel like an urgent thing on their own, but over time, they can quietly cost you thousands. The key is seeing them early and planning intentionally. If you'd like help reviewing your own situation, click the link below to schedule your retirement tax analysis with our team. Thanks for watching. We'll see you next time.